Bismillahirrahmanirrahim. Welcome to my business educational platform. In the last lecture, we have discussed the topics from the role of management, agency theory, the social responsibility, organization of the financial management, the business environment, and the four types of businesses. And then we discussed the financial environment and the financial market. Today we will also discuss from the market, and then we will see what are the financial markets that exist in the financial background. So before taking too much time, let us discuss what is market. Basically, market is the place where buyers and the sellers meet. A market is a venue where goods and services are exchanged. So same is the case with the financial market. It is a place where individuals and organizations wanting to borrow funds are brought together with those having a surplus of funds. So there will be the someone who has the surplus of the funds, and there will be the someone who have the need of that funds. So where they both will meet, that will be known as the financial market. It's same as the market as where the buyers and sellers meet. It is not necessary they meet physically, they can meet virtually, as now there exist the digital markets as well. The purpose of financial market is to efficiently allocate savings to ultimate users. So what are the types of financial markets? There exists the real market that are known as physical asset markets, and the financial market that are known as the virtual assets markets. So a market for exchange of physical assets like cell phones, wheat, clothes, watches is known as the physical market. Physical asset market is the assets we can touch them and we can feed them. Then we have the financial asset, a market specifically for the financial assets and their exchange and transfer. Examples exist like bonds, stocks, swaps, merges, futures, forwards, spot market. So all types of virtual market that are known as virtual and real market are known as the financial assets markets. So types of financial markets exist. There exists the money market. Money market is the market where short-term securities are being traded, like certificate of deposits, mutual certificates. A market for short-term and highly liquid assets. Liquid assets are those assets that can be easily converted into cash within the shorter period of time. Like money market instruments, there exist the treasury bills, commercial papers, deposits, certificates of deposits, bills of exchange, repurchase agreements, and extra. Then we have the capital market, a market where more than 3 months period securities are being traded, known as the capital market, in which more than 1 year, whose life period is more than 1 year, securities are being traded, known as the capital market. It is a market in which individuals and institutions trade financial securities. This type of market is composed of both primary and secondary markets. So basically, primary market is the market where the initial public offering is being traded. Like suppose I am the owner of iPhone and I want to publicize my shares of worthing $15,000 billion. So what I will do, I will initially publicize it into the market. That is known as the initial public offering. Then we have the second public offering, that is known as secondary market, where the firstly initiated offerings are being traded again, that is known as the secondary market. It is the market for already existing and outstanding securities. For example, Karachi Stock Exchange, Pakistan Stock Exchange, London Stock Exchange, New York Stock Exchange, and extra. Stock exchange is a very important secondary market. There are two basic types of stock exchanges that are known as the physical location exchanges and the electronic dealer based markets. The physical location based exchange in Pakistan, there exists the Pakistan Stock Exchange and the Karachi Stock Exchange. So physical location stock exchange versus electronic dealer based markets. What is the difference between them? Auction market vs dealer market, exchanges vs OTC. Then we have the New York Stock Exchange vs NASDAQ, National Association of Security Dealer Based Automation Quotation. Differences are narrowing nowadays. So in real you will see the people's, if you will have a visit in the stock exchange, you will see how the auction is being taken place, how the peoples are being trading, how shouty the market is. Whereas you will visit the digital markets, you will see there the less silence, there will be silence, all the things will be digitalized. So basically it will be the computers who will perform the transactions and all the other datas. So what are the type of financial markets? There exists the spot market. Spot market is the market where financial derivatives or the highly hijacked securities are being traded. So example exists in which in spot market we have the current price at the current time. So market where goods and services are exchanged on the spot means on the time, in the current time and in the current price, that is known as the spot market. Whereas future market is the market where the securities are being traded for future time period and the future cost, future price. Market where goods and services are exchanged on some future date with predetermined price, quantity and date. So what are the other types of financial market? There exists the public market. Public market for exchange of goods and services held publicly, required to get into proper formal contract, is liquid, easily convertible into the cash. Then we have the private market. Market for private contract which are informal in nature and are not liquid. They are not easily convertible into the cash. Then we have the mortgage market. Mortgage market for mortgage loans including the house financing, business loans, etc., which require to mortgage something in return of getting loan. In mortgage market, you cannot get the loans either providing something in as a pledge or as a mortgage. Like you may provide the gold to the bank so that they provide you the loans. Then we have the consumer credit. Consumer loans including the student loan, short-term loans, or car financing, credit card loans, etc., are being traded into the consumer credit market. Then how is capital transferred between the savers and borrowers? Basically, there are three ways, like direct transfers. You can directly transfer it to the firm or an intermediary. Then there is the investment banking house, and then we have financial intermediaries. Let us discuss them one by one. So how you will transfer capital directly? It's very as simple as it sounds. Like you have a cash or you are the someone who has surplus of funds, you will directly provide it to the firm. So this is how the direct transfer of funds work. Then we have the transferring capital through indirect transfer using an investment banker. So firstly, what you will do here, you can see we have a saver. Saver is someone who have the surplus of funds. What he will do with the funds, he will provide it to the investment banks. So investment bank will directly provide their funds to the firm. So who the investment banker will be work as an intermediary to the one who has a surplus of funds and the one who has the need of the funds. From the both he will get in return a commission that will be certain percentage of that funds. So investment banking, how do investment bankers help firms issue securities? They advise the firm, they underwrite the issue, like the what will be the future price of that stock, and how it will perform in future, disturbing the issue and enhancing the credibility. Then we have the transferring capital through financial intermediary. Who is the financial intermediary? It may be someone bank or any mutual fund institution. So saver is someone who have the surplus of funds. It will provide to the financial intermediary or a bank. The bank will provide directly to the firm. So firm will provide the securities to the financial intermediary, and then financial intermediary will provide their security to the saver. This is how that capital is being transferred using an indirect transfer financial intermediary. So what are the type of financial intermediaries? There exist the commercial banks, like you see JS Bank in Pakistan. They are also dealing with the financial intermediaries. Life insurance companies, mutual funds, pension funds, and the financing companies are the major intermediaries that are also working in Pakistan as well. I hope you understood the basic concepts regarding the finance. We will continue our next lecture. Till now, Allah Hafiz. See you in next lecture.